we saw your share price slightly down at the opening today, but really increasing this morning. Investec PLC up by about 3% as we head into the afternoon. Investec Limited up by about 2%. And I think it really was down to the explanation that you gave during your presentation today on why we saw that increase in bad debt costs. So perhaps tell us where they're going from here. Have we seen the worst of bad debts?
Well, I think, we have made us a clear statement that we perceive that the bad debt charge will come down next year. This is the back end of a legacy of the crisis, and we're now confident that we've broken the back of it and we'll start seeing a decline, as you saw in our capital markets business, where you saw a big decline in bad debts.
Of course,
so we're fairly confident that they will start to decline.
What sort of rate would you expect to decline? Because we were chatting to Nerina Fisser at Nedbank Capital just a short while ago, and she's concerned that it might not come down as fast as we have seen at some of the other South African banks, the purely focused South African banks. Is this really because of your diversity and exposure perhaps to the European markets as well?
Yeah, I think if you look at bad debts by geography, they came down in London by 18%. They came down in Rand by about 0.5%. They came down in Aussie dollars by about 3%, and then in Ireland they doubled. So I think it's just a consequence of the fact that we had a small business in Ireland, and that's part of the reason. Obviously, we have had elevated impairments in the other geographies as well, and I think we're going to see a decline in all of those going forward.
You did say in the commentary today, though, that it was a sound operational performance underpinned by strong recurring income. And there has been a move to this recurring income, perhaps potentially also with the asset management business making up a bigger proportion of your total income.
Yeah, if you combine asset management and wealth management, it generated 39% of our operating profit, 41% of our revenue. And, that is quite good progress. It was about 25% last year. That is a different type of revenue. It's there when you open your doors. Obviously, it's dependent on how stock markets do and fixed income markets do, but very clearly it doesn't require capital to generate that revenue, and that's the important thing for us. Almost 40% of our revenue comes from non-capital intensive businesses.
And is this the way you're going to move going forward? Would you like to see even more of your revenue and income coming from those non-capital intensive businesses?
Obviously, you want to generate as much income as possible from non-capital intensive businesses because that helps your return on equity. Clearly, in the not too distant future, you would see a turnaround in the private bank, and therefore that contribution from asset management and wealth management would drop off as private bank starts recovering. But certainly, medium term, we'd want to build that number up sustainably to about 40%.
Are you starting to see that turnaround in the private bank coming through yet, Stephen?
Well, I think you saw revenue was up marginally in the private bank by about 2%. So there is a element of activity that's starting to be renewed, and I think we've broken the back of the bad debts. So we are almost certain we'll see a turnaround.
How about your capital position? Because you're sitting total capital adequacy 16.8% over for Investec in London, 15.9% here in South Africa, and many perhaps disappointed that you aren't paying more of that capital out to shareholders. Is this still a period where you have to be very prudent, just given the uncertainty regarding regulations, particularly in Europe?
I think it's regulations globally. Obviously, there's some new regulations that may come in the UK. I think we've adopted a strategy of, making sure that we build up the right kind of degree of capital to support our activities going forward. And therefore, it would be unwise of us to increase our dividend much more than we did. We increased it by 6% this year. And you have still regulatory uncertainty. You still have challenges on that front. And we have to conserve capital as a consequence. Once we have clarity, then we can, adjust our dividend policy in accordance with the environment we're in.
Do you think you have sufficient capital at this stage? Might you have to raise more capital, Stephen?
No, I think we're happy with our capital levels. Our capital plans show that we have sufficient capital, and we feel that we're reasonably well placed. But we have to be mindful of a very substantially shifting banking regime.
You talk about diversifying your funding sources as well, trying to reduce your reliance on wholesale funding. How's that progressing?
I think you can see that in markets where there are large retail pools of funding, we have significant retail funding both in the UK and Australia. We have very little reliance on wholesale funding. South Africa is a differently structured system, very few retail deposits. In the system, 15% of bank liabilities are retail, and therefore that's much more concentrated environment. So it's different for different geographies.
Stephen, why do you think the market's not rating your share price as it used to, or as it is some of the other South African banks? Do you think they're not seeing the full potential of Investec and what you have been doing?
I don't like to talk about how the market rates our share. I think that we have to continue to run our business and make sure that we're doing the appropriate things. I think that maybe the market was worried about the potential levels of impairments because of the banking side of our businesses and our positioning outside of South Africa. I think everything is cyclical and every dog has its day, and there will be a season when people recognize the kind of business that we built and the kind of quality of our earnings. We've made great strides in terms of building our franchise around the world. We're one of the few South African firms that have made a mark outside of South Africa and have been successful outside of South Africa. So I think that at a point in time, people will recognize the franchise we've built.
Yeah, definitely kudos for that. Stephen, just at the current year, what would you expect for the current financial year?
I think we've made a statement that we expect to see an improvement in the earnings profile as impairments drop off. We gave clarity in our analyst presentation as to what businesses we see growing. We have a reasonable optimism on the outlook. I think things have improved on the ground. Life is still tough and there's still lots of economic conditions issues out there, but we're fairly confident.